What is a registered retirement savings plan? A registered retirement savings plan, or RRSP, is an account that can be filled with different types of investments, including GICs, bonds, stocks, mutual funds, and ETFs. As the name implies, it's a way to save for your retirement. Your savings and investments grow tax-free while your money is in the account. You can buy and sell investments in your RRSP or make other changes. In general, there will be no tax implications as long as your cash, investments, and any returns stay inside your RRSP. Any Canadian who files an income tax return and has earned employment income can open an RRSP. You can save money during your working years in your RRSP until you turn 71. You can open an RRSP at banks, credit unions, investment firms, or online investing platforms. You can even have multiple RRSP accounts at different institutions. For example, you might have a group RRSP with your employer, where contributions are deducted automatically from your paycheck, and an individual RRSP at your bank where you contribute extra savings. How much can you put in your RRSP? You can contribute 18% of your income from the previous year or the maximum allowed contribution for the year, whichever is lower. If you don't contribute the full annual amount, you can carry over any unused contribution room to future years. If you have a pension plan, your RRSP contribution amount will be adjusted lower because of your pension contributions. You can check your RRSP contribution room on your annual Notice of Assessment from the Canada Revenue Agency, or look online at your CRA My Account. Be careful that the total amount you contribute to your RRSPs doesn't exceed your available contribution room. Otherwise, it could count as an over-contribution and you may owe tax. How much money you make in your RRSP depends on the overall performance of your investments, minus any associated fees. You can withdraw money from your RRSP at any time. But if you withdraw before you retire, your financial institution will withhold some of the money for tax purposes. That's because it's considered taxable income when you make a withdrawal. Keeping money in your RRSP until you retire is usually the best way to benefit from tax advantages. What are the tax advantages of an RRSP? An RRSP gives you certain tax advantages, such as tax-deductible contributions, tax-sheltered returns, and tax deferral. The money you put in is not taxed, or you get a tax refund. Your money grows year by year without being taxed. And later on, if your income in retirement is lower than when you were working, money that you take out may be taxed at a lower rate. Remember to factor in other retirement income sources to determine if you will be paying lower taxes during retirement. How do income taxes fit into RRSP decisions? Canadians pay taxes on the income they earn. To decide if contributing to an RRSP is right for you, it's helpful to understand income tax brackets in Canada. Imagine these acorns are the income you earn. Everyone pays a basic federal income tax rate on the first room full of acorns. If your income exceeds that amount, the next portion of your earnings overflows into a second room, where it is taxed at a higher rate. Each additional room is taxed at increasingly higher rates. The higher your tax bracket, the bigger your tax refund or reduction will be when you contribute to an RRSP. And the lower your tax bracket, the less you'll pay in taxes when you withdraw from an RRSP. That's why generally it's best to contribute to an RRSP when your income is higher and withdraw money when your income is lower, which is often the case in retirement. Remember to factor in other retirement income sources as well. Your tax refund depends on how much money you contribute to your RRSP and how much income tax you owe. When you put money into an RRSP, your contributions count as tax deductions. These tax deductions reduce how much tax you owe and might result in a refund. You pay tax when you withdraw from your RRSP. That's when the money is considered taxable income. Many Canadians have a lower income in retirement than in their working years, so paying tax on the money later, or tax deferral, means you'll likely owe less taxes on it than when you earned it. You pay income tax on your savings later in exchange for a tax refund or reduction now. The decision to contribute to an RRSP is personal. Saving money in an RRSP can help you reach your retirement goals. However, there are other ways to save for your future, too. What's right for you depends on your personal situation. It can be helpful to speak to a registered financial advisor to help turn your retirement dreams into reality. Learn more at GetSmarterAboutMoney.ca. Brought to you by the Ontario Securities Commission.